The wealthiest individuals use life insurance, the Rothschild, the Rockefellers. There's a reason the Rockefeller family has become wealthier and wealthier and wealthier over 9 generations. They know without a doubt you're gonna die. Yep. They just don't know when. This is why I love life insurance, literally, because it's a mutually owned company. You own a fraction of the company. You want to live for as long as possible. They want you to live as long as possible. If you don't pay back your policy loan, they just don't pay that amount to your family. Death benefit minus what you didn't pay back. Let's say you get $1 million death benefit, you pay on it for 20 years, you outlive that death benefit. It happens 99% of the time. It only pays out 1% of the time.
It's super misunderstood, and as a result, there's a lot of life insurance that you and I would not be a part of at all. It's like you and I are not unapologetics for the insurance industry.
They're like, why would you do this? Why wouldn't you just sell regular whole life? I tell them, because a regular whole life is probably not the best policy for you. I get this all the time. Oh, well, you don't get both the cash value and the death benefit. Well, yeah, they're one and the same. The cash value is slowly growing into the death benefit over time.
The reason life insurance companies allow you to take an unstructured loan and don't require you to have to pay it back at any time is...
Talk about the death benefit portion and the collateral. So like, let's say, I know the answer to this, but let's say I borrow against my death benefit and I just never pay it back. So what happens there?
There are people that have come to us and they're like, can I borrow again from my death benefit? And it's like, no, but you're not wrong when you say you're borrowing using your death benefit as collateral. So let me try to explain this. So any other financial institution that you get a loan from, you have to pay them. You have to pay them. You can't just have a guaranteed unstructured loan, which you do get if you're with a life insurance company. Okay. So it's like, why do they require you to have to pay that back?
Real quick. Unstructured loan. What does that mean? Because some people might
Unstructured loan means you have no structure in when you have to pay it.
No repayment terms.
No repayment terms while you're alive.
Perfect.
Okay. The reason you have that is they're a financial institution. Insurance companies are a financial institution. They're hedging your mortality, your death, and also hedging interest rates. Whereas majority of institutions that we work with don't have anything to do with your death. They're just interest rate. So they're playing this cash flow game, and they have to get they have to get structured payments. Otherwise, it would be like infinite risk, and they would be dumb. They would be dumb to do that. The reason life insurance companies allow you to take an unstructured loan and don't require you to have to pay it back at any time is they know that they will get that money eventually because you will die someday. And they're either going to get their money one of 3 ways. You're going to cancel the policy, and then they'll just take the difference between your cash value and your outstanding loan and then give you the difference. You're going to die, which they have a permanent liability on their balance sheet called the death benefit, which is an asset to you, a liability to them. They pay you the death benefit subtracted the outstanding loan that you have, or you're going to pay them back. The insurance company is positioned because their long-term way of thinking, they're going to win regardless. They actually have zero risk because they already have a liability on their balance sheet. There's no other institutions that can do that. So when people say you can borrow against your death benefit, I think a better way to say that is you can borrow against your cash value, and because you get the best terms of all time, unstructured, is because of the death benefit. If you didn't have the death benefit, you wouldn't be able to have these structures. So it's you're right. Your part of it is your collateral as a death benefit, but it's an indirect collateral that's allowing you to not have to pay it back because you will die someday. And that death benefit gives the insurance company the permission slip to say,
so if I
take a loan against your policy and you don't have to pay it back while you're alive because we will be made whole at one point.
I might have worded it wrong then, because exactly what you said is what I meant if I didn't say it like that. So what it is, guys, is think of a house. When you buy a house, the house is the collateral to get a loan from the bank, right? If you don't make your payments on the house, what can the bank do? They can take the collateral. Right? Your policy, you're putting money in, that money is the collateral, the house. Houses go up in value. They build equity, right? You put your money into a policy, your cash builds equity. It goes up in value, guaranteed. You can borrow against it, just like a house. You can get an equity line of credit from the bank, right? If you don't pay the bank, they take the house, they take the collateral. In a policy, your cash value is the collateral. So you can borrow against that. You're not borrowing against your death benefit. You're getting an advance of your death benefit. They're basically lending it to you while you're alive, using that money as collateral. So if you don't repay it, they know without a doubt you're gonna die. They just don't know when. They hope, and you hope. This is why I love life insurance.
The incentives are aligned.
You're in partnership. literally, because it's a mutually owned company, you own the company.
Yeah.
You own a fraction of the company. You want to live for as long as possible. They want you to live as long as possible. The longer you live, the longer they can manage that money and grow it.
Yeah.
Right? So like if I put money into a policy at 38 years old, let's say 100 grand, and I'm giving just arbitrary numbers, guys, so don't take this with a grain of salt. If I put 100 grand into a policy and it gets me a $10 million death benefit. If I use all 100 grand as a policy loan and I don't repay it and I die the next day, they have to pay out $10 million minus the 100 grand.
Yep.
That's a lot of risk. They do not want you to die soon.
Yep.
But if I've been putting in all this money over my lifetime and they've been able to make all these profits, their risk shrinks the longer you live.
Yep.
Right? So yes, they are dealing with an inevitability.
Yep.
Not an if. They know you're going to die.
Yep.
So if you don't pay back your policy loan, they just don't pay that amount to your family. Death benefit minus what you didn't pay back.
It's a beautiful thing, and that's one of when we go back to efficiency and multidimensional use and benefits of a life insurance policy, it's more than just rate of return using your money, which are two amazing things. And that's actually the book, The End Asset. I wrote that like 5.5 years ago, and I mainly focused on compound interest and use of money, control costs, control and compounding. Those are like the two C's. And now, like 5 years later, 6 years later, I'm like, okay, that's right. I'm not anti what I wrote in that book, but there's so many more.
It's evolved.
It's like there's 20 benefits rather than just 2. And the more that I just interact with people, I'm like, wow, like that's a really powerful thing to be able to say, because there's, it's, if we just understand the benefits, that translates into value. And that's why I believe if it's set up and used properly and if it's best understood, families should want that as a part of their life, because everything in their life will get better if they understand the kind of asset that they have.
Second thing is the most profitable policy for an insurance company, term insurance. Why is that? You're 27, right?
Yeah.
If you get a 20-year term policy, the likelihood you're going to die by 47 is slim to none. The insurance company knows that.
Knock on wood, yeah.
Right. But they know you're probably not going to die.
Yep.
So let's say you get $1 million death benefit, you pay on it for 20 years, you outlive that death benefit. It happens 99% of the time. It only pays out 1% of the time. So 99% of the time, the insurance company collected all those premiums. Now you're 47. Well, I need another $1 million. Now you're more likely to die in the next 20 years. So what happens to your premiums?
It's going to be way higher.
Way higher, just to get the same coverage. So let's say, you're like, all right, I'm going to get another 20 years. Now you go to 67. You're more likely to die, but still not really that likely. You outlive that one. All that money went to the insurance company. Now you're 67. You want another 20 years? You're not going to be able to afford it.
Yeah, you're not. They're not going to do it 20 years on a 67-year-old.
You're just not going to be able to afford it.
Yep.
So for 40 years, you paid into something that they never had to pay a death benefit on. So what's always pushed? Term, because it's the most profitable for the insurance company.
Yep. I think you're 100% right, whereas it's super misunderstood. And as a result, there's a lot of life insurance that you and I would not be a part of at all. It's like you and I are not unapologetics for the insurance industry. Quite frankly, there's majority of people selling life insurance and pitching it are making their clients worse off for having it.
100%.
It's hard for me to say that, but it's just the reality and the truth. And so you're 100% right. The way that we're structuring these policies is like goes against the traditional knowledge. It's like, why would you want to make a fraction of what you could make? And it's just like, well, if you provide a ton of value, people come all over to work with us. And so it's like it's been one of the reasons why people work with us is because of our specialty, but the reason why majority of people don't do it is for the same reason that you shared.
Yeah, I get that question all the time. Well, dude, why would you set this up if you're making? I'll literally be totally transparent with my clients. Anyone watching this, they'll know. Like, Devin's told me how much he's made off my policy. I'll literally tell them, look, base is 25% of the total you're putting in. PUAs are 75. I'm going to make this much off the base, this much off of the PUA. I'll literally give them my commission. If I did a regular whole life, it would have been this. They're like, then why would you do this? Why wouldn't you just sell a regular whole life? I tell them because a regular whole life is probably not the best policy for you.
Efficiency.
Yeah.
Probably not the most efficient thing for helping you accomplish what you want to accomplish.
Great for your family when you pass away.
Yeah. You and I both have seen overfunded policies have a greater death benefit.
True.
Because you're buying a ton of paid up additions, and so maybe in the first couple of years it's not what it could be, but at the time of your death it could be greater than a typical policy.
But people will ask me like, dude, why don't you just do the other ones? Well, it's not the best thing for you. Okay. If I do this policy and you have instant access to your money, and then with that money, I can show you how to pay off this debt, this debt, this debt, this debt that you're paying all this money to, and you're losing wealth transfers, that money. Now you can plug that hole in your cash bucket. Now your cash bucket starts to overflow. You've got more money. What are you going to start doing? You're going to start telling people. And when other people say, I want to do that, where are you going to send them?
Yeah.
So guys, I have sold, I hate saying sold because I never sell a policy. I explain it. And then every call ends with, well, how can I do it? And then I'm like, glad you asked. And I just set it up. So since March of 2021, I've set up over 1,600 policies.
That's awesome.
So it's just like, I make a lot less per policy, but I've done so many policies that I still make a lot of money.
Yeah.
Right? But let's talk about how the death benefit grows, because to my point earlier, we're building them with a lower base.
Yep.
So upfront, the death benefit is minimized, the cash value is maximized.
Yep.
Explain to people why over time the death benefit grows.
Yep. So if you were to get a typical life insurance policy and it was all base, and let's say the life insurance policy didn't pay dividends, your base, you'd continue to pay in the base and your death benefit would remain level. Meaning if you started with $1 million death benefit, it would stay at $1 million. Okay. So that's like a typical vanilla A whole life policy. Now to
clarify on that though, the reason why that is, guys, is because what you're putting in is guaranteed to reach that at endowment age.
Yes.
So that money is slowly growing into that number.
Yes.
Okay.
So now if you take an overfunded or max funded whole life insurance policy, we're doing a couple things. Number one, we're with a company that pays a dividend. Okay. So there's different ways that we could have that dividend come to us. And what majority of our clients choose is to do what's called a paid up addition, meaning they're paying a dividend and it's going back into the policy. But to do that in a tax advantage way, you need to buy extra life insurance. Majority of what we structure life insurance policies is what's called a paid up addition rider. What a paid up addition rider is, think of it as like a Legos. Every year that you pay a paid up addition, it's like you're adding Legos to your policy, and it's majority of it's going into cash, but to make it tax advantage, you need to buy little extra death benefit. So every time you use a paid up addition rider, that death benefit contractually has to grow to make life insurance, when set up and used properly, tax advantage. Mm-hmm. So every year that you're funding and every year that your dividends are getting paid to you, you care about the cash value buildup, but as your cash value is building up, the death benefit has to grow. Otherwise, you're going to get a modified endowment contract, and a lot of the reasons why you have life insurance in general is you lose a lot of tax advantages. So the death benefit is constantly increasing as your cash value continues to increase, and a lot of times your death benefit is increasing greater than what your cash value is increasing. And so when people say that you lose your cash value when the companies steal your cash value, that would be true if your death benefit never grew. It would be true if you, for 10 years, contributed, then you died and you got $1 million. But it's not true if your death benefit is greater at the time of death than what you, minus what you've put in. I don't know if that's making sense, but if over 10 years you put in and your death benefit is greater than the initial death benefit plus what you've put in, it's it's best of both worlds. And so a lot of our policies over time, it's just fun to see how they grow massively. And that's great because inflation, you want your dollars you want your everything to grow over time. It has to just keep up with the buying power that the US dollar is decreasing at every year.
So to your point earlier of questioning things, right? So I'm going to question something that you did and challenge you on it.
Yep.
Is a regular whole life. You're putting money in, and the death benefit's staying level. So I get this all the time. Oh, well, you don't get both the cash value and the death benefit. Well, yeah, because they're one and the same. The cash value is slowly growing into the death benefit over time, right? So let's say regular whole life, not what we do. You've put in so much money, your cash value is $500,000. Your death benefit's $1 million. You pass away. Your family is getting $1 million.
Correct.
Your cash value was $500,000. They're getting $500,000 plus another $500,000. They're not losing the cash value. You're not going to get.
But you can understand where someone could say, if you put in $500,000 versus if you would have died year one, you would only put in. You can see where someone can say that it steals your cash value, even though you and I both know that's not true. You can.
Oh, so you're saying first year, if you put in 10, you passed away, you're getting
$1 million.
Got it.
But now you were a sucker and put in 5 years and
So that's where I see what you're saying.
Yes,
okay.
Yes. So it's not that you get less money. And a big argument is like, that's what a lot of people say. And they're not wrong with like typical life insurance. Like if you Google or YouTube whole life insurance, and anyone that's like anti it is going to compare life insurance, and they're going to compare the death benefit. They're going to say you could buy a term insurance policy for X, or you could buy the same amount of death benefit with a whole life insurance policy. And it's like, yeah, I agree. Like I'm not here saying to try to cover your insurable interest with whole life insurance. Like we're talking about apples and oranges. We're talking about like there may be a play where whole life insurance, when set up and used properly, creates more efficiencies for your dollars. But a lot of our clients also have term.
Yeah.
I am a huge fan of term insurance. I'm a huge fan of convertible term insurance that gives you options in the future. Why? Because a majority of people cannot afford to insure their greatest asset, which is themselves, with whole life insurance. So we figure out, number one, let's protect you, because that's the first and foremost, the most important thing that we can do. And then if there's extra dollars that we can access to this, let's convert some of that into whole life, and you have best of both worlds. But at the end of the day, like that's kind of the conversation that we have. So I'm pro term insurance, but it's for pure protection. It's not for anything else. Whole life insurance is not an investment, but I don't look at it as solely a protection asset. I look at it as multi-use for your dollars.
Yeah, so we look at things definitely differently, which is good.
Yeah,
it's good. I don't like term insurance.
Yeah.
Because the way these are built, guys, is, again, the modified endowment contract. We've talked about this several times. And I pulled up one of my policies because I want to give you guys some actual numbers. Modified endowment contract. This is something I tell people all the time. The wealthiest individuals use life insurance, the Rothschilds, the Rockefellers. Like, there's a reason the Rockefeller family has become wealthier and wealthier and wealthier over 9 generations. They have trusts in place. They have life insurance with every single child that's born into that family. Everyone dies at some point. When they die, that tax-free death benefit goes into a trust. Trust dictates that the trust is buying more life insurance policies on the next child, right? So it's just a little bit of planning. In 1988, the Fed stepped in because really, really wealthy people were just dumping millions and millions of dollars into these life insurance contracts as a loophole to not pay taxes. And at the time, dividends were like 16% on policies. So think about what you're making tax-free.
Yeah.
With no limit. You could buy a $100,000 death benefit and you're putting $10 million into a policy to grow tax-free. The government stepped in and said, we need to make some guidelines on this. That alone should tell people like, well, if all the wealthiest people were doing it, why wouldn't I?